There are many costs associated with a mortgage that you will need to be prepared for before you start looking for a property. Here are some of them. 1. Deposit. Most lenders are willing to finance home purchases of up to 95% of the value of the property, provided you have stable employment, a clear credit file, and evidence of genuine savings. Some lenders may even add an extra 2% to help cover lenders' mortgage insurance, meaning you may be able to get a 97% loan. 2. Stamp duty. This is a government cost that is usually the biggest expense outside the purchase price of the property. Stamp duty varies between the states and territories. For guidance to the approximate stamp duty cost in your relevant state, go to stampdutycalculator.com.au. 3. Loan setup costs. These are also known as establishment or application fees and will vary depending on the lender and the loan product chosen. Some lenders don't charge application fees. 4. Conveyancing costs. Conveyancing is the process where a property's ownership is transferred from the current owner, the vendor, to the buyer. Either a conveyancer or solicitor should review your contract of sale and ensure appropriate checks are conducted on the property with local government agencies. 5. Legal documentation and settlement fees. There are often a number of government charges associated with settlement. Mortgage registration fee, transfer duty, land titles duty, etc. There may also be other fees such as bank check fees and search service fees. Your solicitor or conveyancer will go through these fees with you before settlement. 6. Inspection costs. It is always recommended that prior to purchasing a property, you hire professionals to inspect the property for structural defects, concerns, pest infestations, or anything that could potentially cause damage to your property. Costs will vary between contractors. 7. Valuations. The lender will order the valuation on the security provided, and this could take up to 3 to 4 days to complete, depending on if the valuer can obtain easy access to the security property. If there is an application fee on the loan, the cost of the valuation may be included in this fee. However, some lenders charge separately. Ask your mortgage professional if you need to pay a valuation or not. 8. Lender's mortgage insurance, LMI. LMI is only necessary if you have less than 20% deposit or insufficient equity in an existing property. LMI protects lenders against a loss should a borrower default on their home loan. It is a once-off premium and in a lot of cases can be capitalised with the loan. LMI should not be mistaken for mortgage protection insurance, which covers your mortgage in the event of death, sickness, unemployment, or disability. LMI can be quite expensive. Your mortgage professional will let you know if you need to pay LMI and how much it is. 9. Insurance. With new liabilities that come with owning property, it is important to consider or review insurance requirements to ensure you are appropriately covered. You will definitely require home insurance prior to your loan settling. However, you may want to consider contents insurance, life insurance, and income protection. To give you an example of costs of purchase when buying a home, in order to purchase a home of $450,000 with a 95% loan of $427,500, you will need a deposit of $22,500 plus stamp duty of about $15,500, LMI of about $14,000, and approximately another $3,000 to cover other costs. So for this example, you would need approximately $50,000 available to purchase a home. If the lender is willing to let you capitalise LMI up to 97%, then the amount required would reduce to $41,000. Please note, this is an example only and information is subject to change at any time.